Hello and good morning, everyone. Welcome back to Almus Market Mornings, your daily dose of global financial updates with me, Swaraj. Starting off with some geopolitical developments. After having drills around the Taiwan Strait, Chinese military announced some major military actions today in the Yellow Sea. For those who don't know, Yellow Sea is more towards the Korean Peninsula. China is in limelight not just due to geopolitics, but also because of the important data releases today. That includes the GDP, retail sales, and industrial production figures. This will help ascertain whether Chinese economy has bounced back as strongly as markets were hoping. Morning, JK. How are you seeing the Chinese economic recovery? The data has been released today. Take us through it.
Yeah, good morning, Swaraj. Actually, let's start with the Chinese data only. There's been a big beat on most accounts. GDP rising 4.5 versus 4 expected. Industrial production 3.9% versus 2.4% last month, and retail sales at 10.6% versus 7.4% expected. Previous month was at 3.5%. These are big beats and underscore the strong recovery in the Chinese economy, contrasting somewhat more sober forecasts seen recently. But the good data is overshadowed by the geopolitical, activities of China, where they reportedly been planning a major military activity in the LOC. So we haven't seen much of a reaction in the currency or in the markets, although ideally it should have improved the overall sentiment. But turning to the broader global markets, yields have rocketed yesterday again after another set of second tier US data that shows that US economy is still not slowing enough, and it's been on a good path. So we saw the Empire State Manufacturing Index developing, and by against an expectation of minus 18, it went to 10.8 from about minus 24 in March. New orders showed a rapid move going to 25.1 versus minus 21. And these are very good numbers if you consider in isolation. But then in the overall, picture of the concerns that the banking crisis has erupted, and also the still hiking in interest rates that is being seen, markets have not taken them very very bullishly. In fact, the new built homes in April for the fourth month also rose again, as the supply of existing home for sale remains much lesser now. Index of current single family home sales was 51, that is sales increasing versus 49 in March. So we have seen a big rise in yields once again. In fact, 2-year has risen 35 bps in the from the recent, 2-year has risen 65 bps in recent times from its low, while 10-year has risen 35 bps. And yesterday itself we saw them move up by 11 and 10 bps respectively, responding once again to the strong data. So overall yields were also supported as one of the ECB members, Nigel, reiterating hawkish stance, while the expectation of May hike by Fed is now inched up to 88% probability. Fed fund futures are showing that expectations that Fed will start cutting rates later this year were pushed back to November from September, and a smaller cut is now being anticipated. So now this is again evolving as we get more and more picture of US economy, but the market will probably wait to see more, frontline data. And also we will see how the more data on consumption and credit will come going forward, because more and more officials have been reiterating that the banking crisis would lead to tightness in credit and affect the demand as well. So all of this did not really see the stock market rally much, although some recovery in stocks from the earlier downtick was seen after corporate numbers, which were better. In fact, we will have, after the large banks that announced results on last Friday, we have another set of big institutions like Morgan Stanley, Goldman Sachs, and Bank of America. But the focus is going to be on hundreds of regional banks who will be reporting in the coming days. And the observation will be the extent of deposit outflows relative to state expectations before also turning to the system-wide lending standards or credit conditions, which has a big bearing on the economic performance also. So one thing, most analysts remain bearish on equities in the US, and that has been sustained for quite some time now, even as markets have steadily progressed up, notching up 5 weeks of gains till last week. So maybe we are going to see a big short covering rally on any big positive trigger, either from the corporate America or from the economy. As for the Fed speak, there was only one person, Mr. Barkin. He said he wanted to see more evidence of inflation easing back to the Fed's 2% goal, and that the economy was just working fine with the rates even at this level. A bevy of Fed officials are scheduled to speak this week, as investors have a heightened focus on their comments ahead of the blackout period that will begin on April 22nd, before the central bank's May 2nd and 3rd meeting. There's also a research paper published by the Fed's Cleveland Fed Center, which says that core inflation will remain higher for longer. Lagarde also made an important statement on the current topical issue of potential shift towards a multipolar currency landscape, saying so far data do not show substantial changes in the use of international currencies, but more importantly for a medium-term implication, she says that the data does suggest that international currency status should no longer be taken for granted. So that's some very important statement. On the FX USD recovery after last Friday's morning flotation with the new one-year low in DXY has been continuing, aided by rising treasuries. DXY was 0.5% up, and the overall oversold conditions in the dollar is still guiding the recovery, along with the yields, even as the market awaits more important economic indicator. Just to touch upon the currency, China also announced that there will be no intervention from them in the FX market, and they will be letting it freely determine the rate by itself, and probably they are saying it at a time when China's yuan looks more vulnerable, and it could be an implicit way of letting the yuan fall as well. On the rupee, of course, it was another intraday session was kind of lackluster, but USD did recover along with the dollar index due to some demand from oil companies. Once again, one more thing of note is that the rupee carry has become less attractive now, relatively falling from 2.57% to 2.3% on an 1-year basis. PPI dipped to 1.34%, which is a 30-month low. But this is the lowest number, in fact, on record after October 2020. It has been helped by a big favorable base effect, and with the recent rise in the crude prices after OPEC cutting production along with Russia, I think this number is likely to inch up in the months ahead. Probably we must have seen the low of the PPI. Overall, rupee stays in a very narrow range between 81.90 and 82.20, and obviously looking forward to flows in the RBI for better indications. Thank you.
Thank you, JK. And just to summarize, of course, the highlight has been the data from China. There was a big beat in expectations with respect to their economic data, which is showing some strong economic recovery. However, markets have not reacted much. The yields in the US have shot up again due to recent data showing economy has not slowed down enough. However, the overall picture needs to be seen rather than these data points in isolation. So basically, 2-year US yield has risen 65 basis from the recent lows. Coming to Europe, ECB members continue to be hawkish, and the rate expectations, rate cuts in the US are being priced from November instead of September. And there is an ongoing result season, especially with the US banks publishing their results this week. For rupee, we are trading in a tight range. The carry has become less attractive from 2.5% to 2.3%. PPI has fallen recently due to base effect, and rupee overall continues to stay in a tight range. That's it from us today. Thank you so much for listening. We'll come back again tomorrow with another round of fresh updates.